All right, welcome everyone. So today what we're going to do is build a kind of mental map of the Canadian income tax system. Look, this isn't just about memorizing a bunch of rules. It's really about getting the big picture, right? Understanding the fundamental structure that answers a few key questions. Who actually has to pay tax? What income do they pay it on? And how in the world is it all calculated? Getting this framework down is absolutely essential because I promise you, almost every single financial decision you make from here on out will have tax implications.
So let's just jump right into the core question that's going to guide us today. Who is required to pay tax in Canada, and how do we even begin to calculate the amount that's owed? I mean, the entire system really is designed to answer this one big question. So we're going to break it down piece by piece logically, following the exact same journey a taxpayer would have to take.
All right, first things first. Before we can even figure out who pays, we've got to understand the rules of the game. So, where does our tax law actually come from? You might think it's just one giant book, but it's not that simple. It's actually a combination of a few different sources that all work together to give us the complete picture. So, think of our tax law as standing on three main pillars. The first and the biggest one is statute law. This is the Income Tax Act itself, the big, complex rule book written by the government. But, words can be tricky. That's where the second pillar, common law, comes in. This is all about court decisions. Judges interpret what the act actually means in the real world. A perfect example, the act is kind of fuzzy on the difference between business income and a capital gain. We really only know the difference because of decades of court cases that have hashed it out. And finally, our third pillar, international tax conventions. These are basically treaties with other countries, and they're super important because they stop people and companies from getting taxed twice on the same income, once here in Canada and once somewhere else.
Okay, so now that we know the rule book, let's get to the first big question. Are you even in the game? Right? The Canadian tax system doesn't apply to every single person on the planet. So the first, most critical step is figuring out who's required to play. And this all boils down to one single powerful concept: residency.
And this, right here, is probably one of the most important things you'll learn in this course. Residency is the key. It's the single concept that determines if you're on the hook for Canadian tax. Now listen closely, because this is where a lot of people get tripped up. Residency is not the same thing as citizenship. Not at all. You can be a Canadian citizen living in, say, Australia and be a non-resident for our tax purposes. And on the flip side, someone who isn't a citizen at all can be living here and be considered a resident. It has nothing to do with your passport. It's all about your relationship with Canada. And this is why that distinction matters so much. If you're a resident of Canada, you are taxed on your worldwide income. Let that sink in. Worldwide. That means income from a job in Canada, rent from a property in France, interest from a bank account in Japan. It all gets reported here. But if you're non-resident, the rules are totally different. You're only taxed on income you earn from Canadian sources. So as you can see, the scope is just worlds apart.
So how do the courts figure this out, this continuing state of relationship with Canada? Well, it's not a simple checklist. It's a matter of fact, and it's all about looking at your ties to the country. Let's use an example. Imagine an engineer from Toronto takes a 2-year contract in Germany. Now, while they're gone, they rent out their house, but they don't sell it. Their spouse and kids stay behind in Toronto. They keep their Canadian bank accounts, their investments, their driver's license. They even fly home for Christmas. See all those ties? Even though they're physically in Germany most of the time, a court would almost certainly look at all those connections and say, yep, you still have a continuing relationship with Canada. You're a resident.
Okay, so most of the time, residency is this kind of gray area, right? It's all about facts and ties. But there is one very clear black and white rule that cuts through all of that. It's called deemed residency. Basically, if you are physically present in Canada, the law calls it sojourning, for more than half the year, so 183 days or more, then boom, you are automatically deemed to be a resident for that year. It doesn't matter what your other ties look like. It's a simple counting game.
So that's how it works for people. What about for corporations? Well, good news, it's usually a lot more straightforward. The main test is super simple. If a corporation was incorporated in Canada, it's a Canadian resident. End of story. Now, there is another way. A company incorporated somewhere else could still be a Canadian resident if its central management and control is here. And what does that mean? It means where the big picture strategic decisions are being made. Think, where does the board of directors meet to call the shots? If that's in Canada, then the company is likely a resident here too. Okay, so we've figured out who's in the game. We know they're a resident. Now for the next stage, keeping score. How do we actually calculate the income that's going to be taxed? This isn't just guesswork. It's a very, very structured process. The whole system starts by sorting every dollar you earn into one of 5 buckets. First, you've got employment income, that's your salary. Then there's business income. After that, property income, which is more passive stuff, like interest from your savings, dividends from stocks, or rent you collect. The 4th bucket is capital gains. That's the profit you make when you sell something like a stock or a building for more than you paid for it. And finally, there's a catch-all for other specific sources, which includes things like pension benefits. Every single bit of income has to fit into one of these categories. So you can't just throw all those buckets together. The Income Tax Act lays out a very specific recipe, a 4-step formula we have to follow. It's often called the statutory scheme. Step 1, you lump together your net income from employment, business, property, and those other sources. Step 2, you add in your net taxable capital gains. Step 3, you get to subtract some specific deductions, and the most common one here is for RSP contributions. And finally, Step 4, you subtract any losses you might have. Once you've gone through that whole process, you land on a really important number called net income for tax purposes. This isn't the final answer, but it's a huge milestone on the way there. We are so close now. The very last step in the calculation is to take that net income number we just figured out and subtract a handful of very specific things called Division C deductions. After you subtract those, you get to the finish line, taxable income. This is the number. This is the final base amount that the tax rates actually get applied to. This is the whole point of the calculation. All right, so we now know who pays tax and how we calculate what they owe. The last piece of the puzzle for today is the practical stuff, playing by the rules. We're talking about the nuts and bolts of actually filing your return and paying what you owe. First stop, deadlines. And no, it's not the same for everyone. It really depends on who you are. For most regular individuals, your deadline is going to be in the spring. But if you or your spouse has a business, the government gives you a little extra time until late spring. Corporations get a full 6 months after their year end. And trusts, they have a much tighter 90-day window. Knowing your specific deadline is, obviously, step 1 to staying on the right side of the rules. And how does the government actually get the money? Well, it's not always a single payment at the end of the year. For most people with jobs, it's done through tax withheld at source. This means your employer calculates and deducts the tax from your paycheck and sends it to the government for you. You never even touch it. But for people with other kinds of income, like from a business, you're often required to make installment payments. This means you have to estimate what you'll owe and send in payments throughout the year. It's sort of a pay-as-you-go system. So you've filed your return. You're done, right? Well, not necessarily. After you file, the Canada Revenue Agency, the CRA, reviews it and sends you a notice of assessment. Now, they generally have 3 years to look at that return again and maybe change it if they think there was a mistake. That's a reassessment. But, and this is so important, it's a two-way street. You have rights too. If you think the CRA got it wrong, you don't just have to accept it. There's a formal process where you can file an objection, and if you're still not satisfied, you can appeal your case to the Tax Court of Canada, and even higher. And of course, what happens if you don't play by the rules? Well, there are consequences. The whole system is built on people complying voluntarily, so the Income Tax Act has some pretty significant penalties to encourage that. We're talking penalties for filing late, for not reporting all your income, and especially for knowingly making false statements. And remember, these penalties are charged on top of the interest you'll owe on any unpaid tax. It can get expensive fast, so it's always, always better to just be compliant from the get-go. So there you have it. We've gone on a quick tour of the entire framework, from where the rules come from, to who has to play the game, how we keep score, and the administrative process. The whole thing is really designed to be a logical, predictable system. So as we wrap up today, I want to leave you with a question. Think about everything we just covered. What was the one rule or concept that surprised you the most? Was it the whole residency versus citizenship thing? Or maybe that super specific formula for calculating income? Just let that sit with you, because it's a great way to start thinking critically as we dive deeper into this subject.